In recent months, a crisis has been brewing in the U.S. industrial and financial sectors that many analysts already call the most dangerous blow to the American auto industry since the oil shocks of the 1970s. The trigger was a chain of events that began in the summer but shifted into an open phase after the October meeting between Donald Trump and Xi Jinping in Busan. On the surface, it looked like a diplomatic breakthrough. Footage of the two superpower leaders shaking hands spread across the networks. But according to insiders in Washington who spoke with correspondents from the Financial Times and Automotive News, the atmosphere of the talks was tense to the breaking point, and their outcome far more alarming than it seemed. Trump publicly announced a temporary reduction of some tariffs, but behind closed doors, there was a series of ultimatums concerning supply chains, rare earth elements, and access for American companies to the Chinese market. And it is in these details, which never made it into the press releases, that the approaching storm for Ford, General Motors, Tesla, and dozens of their suppliers is hidden. According to an anonymous source in the Senate Trade Committee, Beijing issued the U.S. a hard condition. If the White House keeps the new 25 to 30% tariffs on Chinese EVs, batteries, onboard electronics, and metallurgical semi-finished products, China reserves the right to reconsider export quotas for critically important materials, primarily neodymium, dysprosium, terbium, and praseodymium used in electric motors, transmissions, and autonomous driving systems. American companies are already feeling the first effects. According to Reuters, prices for rare earth elements have risen by more than 22% since early September, and component suppliers for Ford and GM have warned of possible delays of 6 to 8 weeks. A representative of a major magnet plant in Texas admitted that if China really restricts exports even partially, they will not be able to keep production at the current level. Most contracts are tied to Chinese processing facilities, and alternatives are almost non-existent. Meanwhile, Automotive Logistics has published an analysis showing that U.S. auto supply chains are more deeply integrated with China than even electronic supply chains, making the industry especially vulnerable. Internal Ford documents obtained by the Wall Street Journal describe a critical scenario in which production of the F-150 Lightning and Mustang Mach-E may be cut by 30 to 40% by the end of next quarter, due to disruptions in deliveries of electric motors and battery modules. A senior engineer who wished to remain anonymous said, "We are running on crutches. Most materials are either Chinese or processed in China. Any disruption and the assembly lines will stop." Tesla has found itself in an even more complicated position. After Trump's decision to revise the operating conditions for American companies abroad, including production in third countries, the White House unexpectedly shifted its attention to Tesla's Gigafactory in Shanghai. According to Bloomberg, the U.S. administration is studying whether to introduce punitive measures for manufacturers that depend too heavily on Chinese production capacity. For Tesla, this could be a historic blow. About 52% of its global output is produced in Shanghai. Moreover, a significant share of electronics, batteries, and autopilot systems is still manufactured at partner facilities in China, despite Musk's attempts to diversify supplies. One Morgan Stanley analyst stated directly, "Tesla is caught between two fires: competition with aggressive Chinese brands in the global market and political pressure from the US." In several closed discussions on Capitol Hill, there have already been voices calling for controlled restrictions on imports of Chinese EVs, including models developed in collaboration with American IT companies. Even the Cybertruck may fall under such measures, because part of its power electronics originates from China. More alarming signals are coming from General Motors. While GM publicly claims it confidently controls the situation, CNBC, citing industry sources, reports that the company is preparing for a deep technological pause in the production of its Cadillac and Chevrolet electric models, because a key supplier of electric drive systems has warned of a likely reduction in export batches of components. Several anonymous GM managers have stated that the escalation of tariff pressure has already pushed cooperation with Asian suppliers into crisis management mode. Some small component manufacturers that supply American brands are on the verge of bankruptcy because rising production costs and tariffs have made their products unprofitable. And while American companies struggle with component shortages and tariff pressure, China is acting strategically and cold-bloodedly. Against the backdrop of the escalating conflict, several of the largest Chinese automakers, BYD, Geely, SAIC, Chery, have begun aggressive expansion in Latin America, the Middle East, and Eastern Europe. According to South China Morning Post, over the past 3 months, Chinese brands have increased exports by 18%, and in some countries, Turkey, Mexico, South Africa, the share of Chinese EVs has already exceeded 30 to 35%. China is effectively creating a parallel market where American auto giants have minimal chances of competing. An employee of the European Automobile Manufacturers Association told Politico that if the US does not stabilize relations with China within the next 6 months, the American auto industry will be pushed at least 5 years back. But the main threat is not even in tariffs or export blockages. It is that China is increasingly restricting American companies' access to critically important technologies. According to Nikkei Asia, Beijing has introduced informal restrictions on the sale of software and industrial equipment for rare earth processing plants, and has begun requiring additional certification for American suppliers. This could paralyze entire segments of the US auto industry because independent processing of such materials requires technologies that have been developed in China for decades. One MIT technology review note states directly that the US has effectively lost control over a critical part of the technological cycle of EV production. It sounds like an analytical conclusion, but in practice, it is almost a verdict. To make matters worse, the tariff war has moved beyond economics and is gradually turning into a political tool of pressure within the US. Amid elections, rising populism, and internal political strife, the auto industry has become a scapegoat. Donald Trump said at a rally in Iowa that if companies do not start bringing production back home, they will face the biggest tariffs in history. Axios insiders write that in the coming weeks, the White House may announce new duties on imports of EVs produced outside the US, including Mexico and Canada. This threatens Tesla with yet another blow. Part of its production capacity and suppliers are located in these countries, and many modules for the Model 3 and Model Y pass through Mexican factories. Ford and GM are also under threat. Expansion programs in Mexico may be rolled back, and that means billions already invested. In this chaos, the largest American automakers are trying to move proactively. Tesla is accelerating construction of its gigafactory in Texas. Ford is negotiating with Australian and Canadian companies for lithium supplies, and GM is seeking investments in rare earth processing in the US. But industry insiders admit, too late, too expensive, and too slow. China is outpacing the US not only in production volumes, but also in political influence, control over raw materials, and technological capabilities. And the tariff war, which many in Washington believed would be a way to tame Beijing, is ultimately turning into a trap, hitting those least prepared for it, the American auto giants. Inside analytical circles, a new expression has already appeared, the automotive shock of 2026. According to experts at the Brookings Institution, if the conflict is not resolved, by the end of next year, EV production in the US may shrink by almost 1/3. And that means not just a shortage of cars, but mass layoffs, shortages across dealer networks, rising prices, and a loss of competitiveness on global markets. The irony is that the US, while trying to stop China's dominance, is giving it the perfect opportunity to cement itself as the world leader in the automotive industry.